So if you are a limited partner, which means you're a passive investor looking to make passive investments, or they have, let's say, $50,000 or $500,000, I would absolutely vet the partner more than I would vet the deal. That's not to say to not vet the deal. Obviously, you should spend time with the deal, but I'm putting the emphasis on the partner. It's that cliche of betting on the jockey, not the horse.
Welcome back to another episode of Keeping It Real Estate. I'm your co-host, Dan Breezy, and today we have Rob Beardsley joining us on the show. Rob is the founder of Lone Star Capital with over $500 million in multifamily real estate acquisitions. He's an author, speaker, and podcast host. Rob shares expertise in multifamily investing and business fundamentals, including raising capital and underwriting. With that said, Rob, welcome to the show.
Thanks for having me.
Yeah, I'm glad you're here. So, Rob, you're a pretty young guy, 27 years old. You guys have $500 million in multifamily real estate acquisitions. I think the first question people are going to ask is, how are you doing it? How did you do it?
Well, as far as the youth angle, I got an early start, which I'm very grateful for. I had a lot of things going my way. I grew up in a real estate family, so my parents were involved in residential brokerage. So while that's not exactly what I'm up to today, it definitely helped provide a basic foundation for real estate transactions, but not necessarily investing. And then I was also very fortunate to, while in college, be quite curious and exploring ways to build a business, to invest capital. And given my background in real estate, I stumbled onto podcasts and forums and meetups related to multifamily, and basically was able to join a mentorship group, meet my business partner, and get my first deal under contract, and then drop out of college all before finishing my second year of school. So I was able to start the company at 21, which is how, it's taken a long time, right? 6 years, at least to me, feels like a long time. I know that's not necessarily the longest career or the longest time to build something, but it's been 6 years now, and we've definitely come a long way in terms of building up to now owning $600 million in assets.
Yeah, got it. What mentorship program did you join, if you don't mind me asking?
My business partner and I, we were a part of Joe Fairless's mentorship program back in 2017 and 2018.
Gotcha. Okay, 2017, 2018. And in Joe's program, they teach you multifamily acquisitions.
Yeah, exactly. And we pretty much had the program laid out in front of us. Not necessarily like every single step was mapped out, but just to be surrounded in an ecosystem of doers and people that had done deals already gave us that belief that we could take the first step, which obviously leads to the next and the next. And if you bump into issues, there's people there that have probably already encountered those issues themselves.
Yeah, good stuff. So looking back, what was your first real estate investment into multifamily?
My business partner and I, we kind of bit off a very big deal for our first deal, but that's just how it happened, and that's how it came together. We actually put a 261 unit Class C multifamily property in Houston under contract as our first deal, and this was a heavy lift. This had a lot of hair on it. Knowing what we know now, we would not have bought that property, but because we were green and because we were naive, we thought, sure, let's buy this rough deal and do a turnaround play. How hard could it be? And then, of course, we eventually learned how hard it could be, but nevertheless, that served as a really great lesson. So we learned a ton of things about operations, managing properties, investor relations, managing investor expectations, communication, and all that good stuff.
Yeah, good stuff. So when you guys bought your first deal, was it a brokerage company that helped you find it, or was it off market? Or tell me a little bit about that.
Yeah, it was through a broker, a local broker in Houston. The deal was off market, so we were able to secure it through a very large non-refundable earnest money deposit. And I mean, we kept the deal away from being fully marketed, which probably saved us a little bit on the price, but nevertheless, it was still being sold by an institutional owner, being sold by an institutional broker. So it's not like we were knocking on doors to buy a $20 million deal. A lot of people in my space ask about how to source deals and how do you find the best deals. And the unfortunate reality is when you're dealing with properties that are these days even $10 million and up, but especially in our space of now today, we're focused on $30 million deals or even greater. it's very, very unlikely to encounter an unsophisticated owner that's willing to sell directly without a broker and at a below market price. There's just too much sophistication in the space these days, at least in the bigger assets and the more institutional assets. So we have to find other ways to create value.
Yeah. Do you guys still own that deal in Houston, or have you exited?
We exited in December of 2021.
Oh, nice. Good stuff. Do you guys, with what you're sitting on now, have any deals that, let's say you're looking at the debt and you put short-term bridge financing on? Are you guys in any situations like that, or did you steer clear of all that bridge loan?
Yeah, we have one bridge loan in the portfolio. So we're dealing with issues there as far as the dramatic rise in interest rates and dealing with the lender. There's a lot of difficulties associated with that we're not unique in experiencing, right? But we certainly are going through it, like everybody else that did take on short-term floating rate debt at unfortunately the wrong time, which was kind of around 2020 and into early 2022. We're just having to work with the lender on getting construction draws released, doing the work so that we can raise rents, so that way we can catch up and kind of stabilize the deal and work towards either a refinance and or a potential eventual sale.
Yeah, definitely. You guys, so if we got 500 million of assets under management, how many assets are you guys currently overseeing?
We have 17 properties in the portfolio.
Okay, gotcha. So 17 properties, only one bridge loan. That's pretty rare in the sense that so many other folks had more. What was your reason for not going with more variable rate bridge loan debt?
We definitely got caught up in the craze of the times and how it was just a very aggressive time. Money was very cheap. But with that being said, I want to say we're a little more conservative than most. And we were just finding ourselves outbid on a lot of deals. So, for better or worse, we didn't necessarily go on the biggest buying spree, which at the time it was hard, right? Seeing other people do really well and acquire a ton of deals and have record years where they're just buying up a ton of assets. But now in some ways we're blessed actually to have had a bit of a slower run, and we were also a younger company. So as the market was heating up, we also were building our relationships and reputation and our ability to transact. So back in 2020, we were just a few years old and we didn't have the ability to go buy 5, 10 deals. I think we only did 2 deals in 2020 or something like that. So we just are fortunate to be new, but not too new, and then fortunate to be a little more conservative.
Yeah, good stuff. How do you guys, when you're looking now, what markets are you investing in, and what is something that's a promising real estate investment with where you're at now?
Yeah, the good thing about us is our focus, and we've stayed focused from the very beginning. Our very first asset was in Houston, and we've continued to grow and build on that success in Houston, but we've also acquired property in Dallas and now San Antonio. So those are our 3 major markets. Those are obviously the top markets in Texas minus Austin. We're not in Austin, not for any particular reason, just because we just haven't decided to go there. It's very hot and competitive, so we're just focusing on the other 3 markets where we feel like we can be more successful. With every market or strategy that we add on as a area of focus for us, it dilutes our efforts. So we're very careful about where we're spending our time and making sure that, because if you try to be an expert in everything, you're not going to be an expert in anything. So those are our markets of focus. We try to stick to workforce housing. That means, properties that are usually 20 to 40 years old. We don't necessarily want to buy the nicest property in the neighborhood, but not necessarily the worst property either.
Got it. Gosh, that's great stuff. So when you guys started raising capital, where was most of your equity coming from?
Our capital raising journey started like most, which was with friends and family. We had, I would say, a fairly decent friends and family network, but like everybody's, it eventually runs out and you need to expand beyond your friends and family to really be able to grow. So that was a frustrating experience because I feel like my business partner and I, neither of us got into real estate thinking very much about raising capital. And we kind of felt like it was an afterthought. We felt like it was a chore, something that we shouldn't focus on. But we were obviously really wrong because it turns out raising capital is a really, really important thing. You can have the best deals and the best ideas, but if there's no capital behind you to actually go and implement those strategies and ideas, then you'll have nothing. So we had a bit of a wake-up call to that, and we started investing heavily into building relationships, into marketing, into branding ourselves so that we could actually build a strong network of investors who would come to know, like, and trust us, which of course takes a long time. So that was kind of the early days of realizing that we needed to actually put our full-time effort towards this, or at least one of us did. And then also something that was a bit unique, but a really fortunate experience was on our second deal, we had the really good fortune of partnering with a private equity firm out of Houston. And that was kind of a little bit of a breakthrough moment for us because it put us on the map a little bit, to have that backing from a good reputation, sophisticated private equity group. And then also the ability to partner with them. They're the ones giving us the money, but it's like we're the ones getting the education, right? For free, basically, or they're even paying us to learn from them because while they're the limited partner, they come with decades of experience and they're able to really provide a ton of insight as to how a sponsor like us should treat a sophisticated investor like them.
Yeah, it's great. When you were going about branding and working on getting out and building a further relationships with investors, what sort of things did you start to do?
We started to, it was mostly on me. So something that I started with was, given I was so young and kind of embarrassed about my age, I didn't want to make videos. I didn't want to do podcasts like this or really do anything in person. So one of the things that I focused on was actually writing articles. So I started producing, in my opinion, very high quality, insightful, kind of more advanced topic articles, if you will. And those did really well. Those kind of built up our credibility, which is at the end of the day what you want to do through your content. You want people to see, oh, this person is knowledgeable, they're credible, I'm interested in working with them. So writing was kind of the first start. But something that I learned and had to kind of hear many times from mentors to really have this sink in as I was dealing with my youth and my imposter syndrome was, if all you do is provide good information through your branding and marketing content, then people aren't necessarily going to fall in love with you. They might love your information, but they can just use you as an encyclopedia or as a dictionary and then just move on. So at the end of the day, you have to build a personal element into branding. And that was something that I resisted because I didn't want to build a personal brand per se, and I didn't want to show the world me. But then over time, that's what we did, and I got more comfortable. So I started making videos, and those videos really took off. We were posting every single day on LinkedIn, on YouTube, doing podcasts. So it's like if someone were to look at the marketing platform that we have today and the branding that we do across different social media and different mediums, people might think, oh, wow, that's really impressive, or that's overwhelming, or that's a lot of work. But the reality is these are all just little bricks stacked up on top of each other, building up this big ecosystem. So you just start with one thing and it just starts stacking up on each other. And then now today it runs, without my involvement at all. I just kind of sit down, record something, and then we have a whole team that will do editing, posting, clipping, distributing, etc.
Got it. Gosh, good stuff. I love it. When you were at the Joe Fairless event and you met your partner, how did you identify and say, yeah, this is the right guy, or is it a gal, or I don't know. How do you know if this is the right partner for you?
Yeah, so my partner's name is Kent, and we didn't meet. It's actually funny because from my perspective, we didn't meet and plan to build a partnership from that day on. But from his perspective, he actually went to that conference with the goal of meeting a partner. So he was at that level where he had already done a few deals and been partnered on a couple projects. And he was actually looking to take it to the next level and go into a full-time venture with a partner. So he was looking for a partner to kind of match his passion and effort. I was kind of even too new to even really realize I needed a partner because back then I was still hoping that I would be able to build a new business and partner with my dad because, my dad and I are best friends and it would just be such a special thing to build the business with him. But I had to eventually realize that he was, one, too busy with his main brokerage business, and two, he just wasn't the right fit to be a partner. My partner and I are much better fits for each other and just a much better partnership all in all. So nothing to take away from my dad. It just is what it is. So long story short, it really, I would say was mostly luck. I wish I could tell people like the best strategy and advice to finding a partner, vetting, and etc. But it really was just right place, right time, perfect fit. And The only thing I can really say is that while him and I are very different in age, in backgrounds, in education, and in personality, the one thing that we do share is respect. And I think that's by far the most important thing. You can't have any relationship, whether it's, marital, business, friend, anything, without that baseline of respect.
Yeah. Yeah, that's good stuff. So you're in New York right now. Do you live in New York, or where are you guys based out of?
Yeah. So my business partner has lived his whole life in New York, and then I grew up in California, but I moved out here 5 years ago, and we started building the business out here together. So I'm sitting in the office today. We have an office here in New York at the One World Trade Center, and this is where our acquisitions, asset management, accounting, finance, marketing staff is. And then down in Texas, in Houston, we have our actual director of construction, vice president of property management, regional managers, vice presidents, et cetera, that actually are the boots on the ground managing the portfolio.
Got it. Do you guys manage vertically, or is it third party?
Yes, we are vertically integrated. So everybody I just mentioned there that's down in Texas, those are all people on our team. So we've been growing that management company. We actually brought property management in-house when Lone Star only had about 800 units, which is pretty small. I'd say most companies build up to a bigger portfolio size using a third-party manager, and then they transition the assets in-house once they have more scale. We're just a little more ambitious, a little less patient, and we just wanted to go in-house sooner so that we could have more control and we could really build out the property management the way we wanted it.
Yeah, when you guys went about building it out, how did you go about doing that with your 800 units? What was your first couple steps?
Yeah, so the two most important functions that are the core of property management are, the simple one is the accounting. At that point, when you're smaller, I think it's easier to hire a third party accounting firm rather than try to bring accounting in house. I could be wrong. I think it just kind of depends on how you want to do it. Looking back on it, I would actually say probably we maybe brought accounting in house a little late. But anyway, the most important thing is the accounting. And then the even more important thing is the actual management, which is done by a regional manager. So, regardless of whether it's in house management or third party management, the regional manager that's involved with a particular property is the most important person involved in the deal. And that's because a regional manager is the one that's tasked with overseeing the on-site staff, which means they are responsible for hiring, training, and firing that on-site staff. And that's what makes a property run.
Yeah, that's good stuff. Looking back, do you guys think you'd have done anything different or kept it exactly like you did it?
Yeah, like I mentioned, I think that looking back now that we do have accounting in house, I think we probably were a little late to that game. I think it's really helpful to have a professional third party accounting firm that can do the accounting for your properties, maybe to start. But I think bringing it in house is really valuable because we have more control, more speed. It's kind of like everything else that you bring in house. If you do it right, then you have more control. You can probably even reduce cost. But the whole property management business is such a low margin business. It's really not about making a profit.
Yeah, it's just control to control the value of the asset and make sure that you've got the right team in place, huh?
That's right.
Good stuff. So, looking at your projects, if you're looking to teach or help someone, maybe you guys had a challenging project or something at a property, what would be something that you're looking back on with your experience to say, hey, here's something that you could learn from me from and not experience what we went through?
Yeah, I think there's so many lessons. So it just depends on where or what side of the table you find yourself on. I'll just quickly cover a few of them. So if you are a limited partner, which means you're a passive investor looking to make passive investments, the trick there is there's a lot of exciting people you meet and there's a lot of exciting potential deals to invest in. And what I see a lot of people do is they invest a lot of capital into the first deal that's pitched to them or the first good deal that they see. And my advice to someone who's in that position where they have, let's say, $50,000 or $500,000 that they're looking to invest, I would be very patient, take my time. I would build relationships and I would absolutely vet the partner more than I would vet the deal. That's not to say to not vet the deal. Obviously, you should spend time with the deal, but I'm putting the emphasis on the partner. It's that cliche of betting on the jockey, not the horse. And I think that's just super, super true in our industry. So from a passive investor standpoint, that's my big piece of advice, that by being on both the passive investing side and on the other side as the sponsor, taking in passive investor capital, I see that, and I think that's the biggest piece. From a sponsor point of view, as someone who wants to get in the game and start their own company that will actually raise capital and oversee investments, I think my two big pieces of advice are: one, going back to my wake up call about raising capital. I think the sooner that you recognize capital raising as the monstrous full-time job that it needs to be, the better. Right? You have to pay its respect, and you have to really have a game plan built out as to how you're going to create, nurture investor relationships and really scale it. You've got to get scale when it comes to raising capital. And then on the actual business side, the big piece is to build out your team before you need them. Because once you already have a deal under contract, it's too late to go and vet out a property manager to partner with. It's too late to go and vet out a lender. It's too late to go and vet out a loan guarantor, right? You need to know what pieces of the puzzle that you need, and then you need to go and put those pieces together before you have the deal, because you don't want to be scrambling when it's under pressure.
Yeah, good stuff. I agree with all those wholeheartedly, Rob. What do you guys see, or what's your perspective of, let's say, the next 3 to 5 years, or even 24 months in multifamily? Do you think we bottomed? Do you think rates are still going to climb? Cap rates are going to climb? Where do you guys sit with that?
Yeah, I think the market is just in a really interesting place. I mean, nobody ever knows where the market is going, but right now it just feels a little less certain than normal. On some level, I think that cap rates peaked back in December or January, and I think that cap rates have already come down a bit. But with that being said, I still think that it's possible for prices to continue to come down, right? Just because cap rates have come down now a little bit, it doesn't mean that if NOI drops, that could further bring down pricing. So I think the capital markets have been all over the place. Interest rates have gone up, they've gone down, they've gone up, and cap rates have done the same to an extent. But revenue and income have been still fairly solid. Depending on where you are in the country, there's been some difficulties on the expense side of the equation, from property taxes going up, insurance going up. But at the same time, we've started to see property taxes come down in some cases. We've seen insurance come down even in some cases. So that's kind of up and down. But what I think is the next step for the market, unfortunately, is to experience a slowdown in revenue. We've seen rent growth slow down, go flat, in some cases go negative. I think there's a good chance that the economy slows down and perhaps even goes into recession. And that is likely to cause tenants for multifamily to not be able to pay their rent, to downsize. There's a lot of negative factors that could play into on the revenue side, which can further bring down pricing. So I think right now, while we don't know the future, we're being more careful about the quality of asset that we are looking to buy, the margin of safety, and also the business plan that we're looking to implement. Because if you think that the next 24 months might be a little bit rocky from a rent perspective or a collections perspective, you may not want to do a really aggressive business plan where you're projecting to raise rents a ton.
Yeah, that's good stuff. What are you guys using for debt currently? And are you buying assets right now, or are you in a wait phase?
We are actually actively buying right now, and we've been mainly doing 5-year fixed rate debt. Last year, we did 7-year fixed rate debt primarily, and that was when rates were lower, and now rates are higher today. So while we still like the fixed rate debt option and think that's generally speaking the best option in the market today, it's kind of just the least worst option today. But instead of doing a 7-year debt term, we're doing 5 years because the rate's kind of high and we don't love the interest rate. So yes, we do want to lock it, but we don't want to lock it forever. So we'll take the 5-year debt and then look to sell or refi in hopefully 3 to 5 years.
Got it. Good stuff. So as a speaker at real estate conferences nationwide, what are, the most pressing topics that you find yourself discussing or industry professionals discussing right now?
Yeah, right now, the market and debt are two really hot topics. I mean, I'm no market expert, so I don't necessarily spend a ton of time talking about that. But I definitely am a bit of an expert on the debt and equity side of deal structuring. So, a couple years ago now, almost 2 years ago now, I published a book called Structuring and Raising Debt and Equity for Real Estate. So I do speak at conferences about how to put deals together, what debt structures to use, how to raise the equity behind that. And that's a fun topic to talk about because it's like every conference I go to, it's different, right? The story is different, the environment is different, so there's always nuances to add to that discussion.
I love that. So my next question was going to be just in regards to a book, a recommendation. So real quick, what was the title of the book one more time for our listeners?
It's Structuring and Raising Debt and Equity for Real Estate.
Structuring and Raising Debt and Equity for Real Estate Investing. Okay, good stuff. Well, I'll have to check that out. Any last words, Rob? Any comments? Any way for our listeners to get a hold of you before we wind this down?
Yeah, absolutely. If a listener would like to get in touch or learn more about us at Lone Star Capital, please head over to our website. That's lscre.com. That stands for Lone Star Capital Real Estate. So on our website, you can get a bunch of free resources. We have a free download of our underwriting model that we use to analyze investments. We have free ebook on passive investing. And there's also links to the 2 books that I've published.
Awesome. So you got an ebook, you've got a underwriting spreadsheet, you've got a link to a passive investing. Good stuff for you guys there. Thank you so much for joining us on today's episode. We hope you found it both informative and entertaining. If you did enjoy the episode, we'd be thrilled if you could share it with your friends and family or anyone you think would enjoy it. Your support means the world to us, and it helps bring us great content and guests on the podcast. Don't forget to subscribe. Until next time, we'll see you on the next show. Thanks, Rob, for joining us.